Afternoon, ladies and gents. Simon Brown here doing today's webcast, looking at financial ratios. We've done this is number 4 in the series that we've been doing over the course of the year. If you're looking for the others that we've done. So I alternate between trading Aussie and some fundamentals, one a month alternating. If you go into online share trading under the special announcements, look for webinar downloads. You'll find the others there. And today we're going to doing as I said, financial ratios. And the first point is that there are, I was going to say millions, and that seems a bit extreme, but certainly there are a heck lot of financial ratios. There's more than one would imagine. And I'm obviously going to focus on the ones that are either the biggies or the ones that I typically go to look at. And oftentimes we need to create them ourselves. But we'll also have a squiz at the online share trading website as to where we find them, where we find the raw data. And some are easier if you've got to create it yourself. Some are a little more complicated, but we'll delve into those as and when we need to. The point is we attach different importances to them. And now that's both industry attaches different importances, but so does an investor. You know, some people care nothing for one and others think it's absolutely brilliant. It's also important to understand that the different industries have different ratios. You know, mining has head grade, banking has cost to income and impairments. So, you know, some are standard across. And the common ones we all know is HEPS, headline earnings per share. That is an IFRS term. You'll see normalized HEPS, you'll see core HEPS, you'll see there are two terms that are IFRS. And IFRS is our accounting standard, which is HEPS, which is basically profit with abnormal items stripped out, and then diluted HEPS, which is saying any shares we know are going to be issued in the future, i.e. options or something to directors, are included in today's share count. So that's your key number. Your second is dividend yield. Obviously, that is an easy one and provided everywhere. It's the dividend as a percentage of the share price. It's a dividend over the last 12 months, and it will include a special dividend if it was paid over that period. Price earnings ratio is our sense of evaluation tool. It's literally price into which we divide the earnings per share, now into which I would go and divide the headline earnings per share. And that gives us a number. In many cases for the market, it's around 19 on average. We've got NASPAS up in the 80s and so. And what we're looking at here is a fairly rough, rudimentary, ready but workable valuation technique. And I quite like it. What I take it as a step further, which is essentially a PEG ratio, which is PE divided by growth. In other words, if your PE is 20 and your growth is 40, and I'm looking at growth in HEPS, so 20 divided by 40 gives you 0.5. Anything below 1 is offering value. So a couple of points on it. Firstly, of course, growth is going to be changing as businesses mature, as they expand, etc. But also, you know, you're looking at next year's growth, which is therefore a bit of a guessing game. So I will often, if a set of results comes out, the first thing I would do is, what's your current PE? What was the HEPS growth? And I'm frankly looking for growth to be ahead of PE. If growth is ahead of PE, then I'm saying, okay, there's very potentially there's some discount. There's a value play here. We've got a share that's offering some value and perhaps worth looking at. I won't walk away if it's the other way around. If say your PE is 20 and your growth is only 15, okay, that's a 1.33. Not great, but let's dig. But if your PE is 100 and your growth is 10, we have problem. So it's a nice, it's sort of, you know, rough and ready. It works well. So HEPS, dividend yield, PE, PEG. Simple. You probably all have come across them at numerous times on the website, the Just One Lap website. They provide those numbers in the various places. We'll go have a look at a moment. And those are pretty much standard across everything. You can apply those to anything. Your most cyclicals, then PEs get a little bit complicated. They, in the mining space, during the bust years, the PEs go through the roof. And during the boom years, the PEs collapse. So it's a little harder to smooth them in a sense. PEG, a lot of people don't bother with. To me, it's a nice, easy one to work with. And then, of course, as I said, the different in the different industries. But first off, where do you find them on the online share trading platform? So you would go to a quote page. You would, on the quote page, click on company profile, full financials, and then ratio analysis. So let's quickly go and have a peek at that. So let's pick a stock. I suppose we should use Standard Bank. So you click on company profile. There's your forecast company news. So if you want to go and find previous numbers, etc., you'll find those under result summaries. There's your glossies. There's your financial numbers. So this is just a sort of a stripped down your balance sheet, but in a nice, easy format. You can also drag and drop it into Excel, which makes life a whole lot easier. And there's a whole bunch of your different statistics that we're looking at. We're going to touch on some of these, some we won't. Some of them are just, for example, what was the high and low for the period. And then you've got all your ratios coming in down here as well. For example, but these are as the results come. So the PE for Standard Bank was 9.5. These were the June results, probably only published in August, maybe September. And they take that HEPS and they put it into the price for end of June. Question, great question. So in your interim period, are you only using half the HEPS? No. So what you would do in an interim period, you would take, for example, dividend from there and the final dividend. You would take a HEPS for that 6 months period and the HEPS for that period. In other words, that full year less that interim plus the 2017. Sorry, I was touching my screen. That didn't help you. So the full year HEPS minus the interim for that year to get you just the second half plus the interim for the second year. And that gives you the HEPS there. And if you're not sure, what's dividend cover? You click on that, and it gives you all the explanation of what all the various different terms, etc. are. Question around, give me a sec. So there you're going to find your dividend history as it's paid. Down here, you're going to find the dividend yield after tax and the PE ratio. Earnings yield is just an inverse of the PE ratio, so expressed as a percentage. Instead of price earnings, it's earnings into price. Let's get back to that. So that's where all the data is. It's all there. I mean, everything's there. There might be some ratios that we like that we can't find. Then we have to go get the raw data and create it, but there is a chunk there already. So a couple come from the balance sheet, return on equity. We went into detail. The link is there for the balance sheet webcast. Essentially, return on equity. Equity is assets less liabilities. In other words, in many senses, your net asset value, which is an important number. And then how much profit are you making on that? Now, what is your return on equity? In the banks, typically in the mid to high teens, FirstRand being an exception, where it's in around the 24%, if I remember correctly. Woolies had return on equity at one point up at around 50-odd%, I think it peaked at. Of course, it can be manipulated in some senses in terms of equity, assets and liabilities. You can massage both assets and liabilities by revaluation, by write-downs, etc. But it's a good, I want to say old-fashioned. One of those ones that perhaps not as much used these days, but certainly is an important measure. And then your net asset value or your tangible net asset value. So net asset value is simply assets minus liabilities, net asset value. If you were to liquidate the company today, you can then do net asset value per share, where you just take the Rand value and divide it by number of shares. I like tangible net asset value, which will remove goodwill. Because goodwill, so if Standard Bank were to buy a bank and say they paid R1 billion for the bank, but the assets are only 800, then that means there's 200 of goodwill. That goes onto the balance sheet as an asset. But is it really saleable? Is it really, I get that there's value, but it's not a realizable value. I want net asset values to be, property, plant, equipment, buildings, cash, that sort of thing, properly realizable. And then current ratio. So current assets and liabilities are those redeemable within the next 12 months. So a debt that's due in 12 months, or maybe a debt that's going to be paid to you in 12 months' time. So current ratios, current assets versus current liabilities. And it just gives you a quick idea of the liquidity of the business, how easy they're going to find it to potentially pay any debts, etc. Now, of course, they're paying debts in many cases from revenue, but this just gives you, particularly if they're under a bit of a debt crunch, it's a nice, quick and easy way to get a sense of how the company is positioned in terms of its debt liabilities. As I said, a link there, you'll find the video, which gives you a lot more into the balance sheet. We're just touching on it here. We go into a lot more on those various different ratios as well. And then the other one that I looked at is debt, and we did one back in June on debt, and there's the link for it there. And there's two really that come into case. One is debt equity. In other words, remember that equity number which we had for return on equity, which is net asset value in a sense. So what's your debt relative to your equity? If your equity is 100 million and your debt is 500 million, yo, man, you're what we call overgeared. If your equity is 100 million and your debt is 50 million, you're at 50% gearing, that's acceptable. That's reasonable. Typically, companies are going to run their gearing levels between about 30 and 70%. Oftentimes, what you will find, and you need to go and dig into the annual report to find this, is that the company will state what their target debt to equity is. In other words, what level of debt are they comfortable with? So you can see, if their target is 60 and they're on 30, okay, they're probably looking around for an acquisition, take on some debt, grow the business. If their target's some 60 and they're currently on 80% debt equity ratio, you can say, well, okay, they're probably not doing an acquisition. And if they are, there are going to be some hard questions from shareholders. And more importantly, what are they doing to get their debt equity ratio down to their 60% target level? And then interest cover, which is literally, of the interest being paid, how easy to pay off. So interest covers interest, and you take the total, the headline earnings, not per share, the headline earnings covered by interest. And again, that's a liquidity issue, telling you how easy is it, are they finding it to pay off their debt. I talk about it a lot in the webcast, and the link is there, but let me quickly touch. Debt is not bad unless it cripples your company. Now, what I mean by that is if you're using debt to expand, to upgrade, to merge, or to do acquisitions or something, debt can be great. But too much debt can almost potentially and absolutely can cripple a company. So that you've got to watch those debt levels at the same time. And it's not, 10 billion of debt is a useless number. We need to relate it to something. And that's the point with ratios, is numbers in isolation are great, but they're fairly meaningless. That's why we've got to say, well, HEPS is this, but what's the PE ratio or something? We look at numbers in relationship to other numbers. Some general ones is dividend cover. This is one I always look at. Again, the company will many times have a dividend cover policy, which they may disclose in the results. Certainly, they will disclose in the annual report, and that is how much of HEPS is paid as dividend. So if the dividend cover is 2, and they make 3 rand of HEPS, they'll pay out 1.50 rand of dividend. So the HEPS is twice dividend. Some stocks, Metrofile, dividend cover is about 1.1. So they pay out most of their money. Coronation, the dividend cover is almost 1. They pay out most of their HEPS. Almost 100% of HEPS goes out. Some stocks will have smaller dividend covers, higher levels, smaller dividends. They'll have dividend covers of 2, maybe 3. And it gives nice guidance to shareholders. You can also see the change. Let's look at Metrofile. At some point, they weren't paying a dividend. Then they started at a 2.5 times dividend cover and have slowly worked it down. I think they're actually looking at a range of 1.1 to 1.3. But it gives you a sense of expectation. And if they suddenly veer off, if they're promising you a dividend cover of 1.3 and suddenly they only pay you, 2.3, why? Why did they take a whole bunch and keep it rather than pay it out to shareholders? I might not mind, but I want to know what the story is. And that's what's great about ratios, is I don't want to say they raise red flags, they raise flags. Look at me. And then you can go and ask the questions and see what the story is. And that's what's really great for them. Price to book, typically used for banks, but can be used across anything. And that's, again, back to that net asset value or tangible net asset value we spoke about a moment ago. Price to book says, okay, so you've got a net asset value, but a company is always trading at a premium to that. Now, you don't buy Standard Bank for its net asset value of, say, 120 Rand. You buy it because of the profits it's going to make. Now, what you do is you measure the price to the book. So, I don't know what the Standard Bank net asset value is. Let's go have a quick peek. So we can find it easy enough. We get a company profile. We scroll all the way down to ratios. We get a net asset value per share of 94 Rand. And I can tell you that the Standard Bank price as of a moment ago was 170 Rand. So that's a price to book of about 1.78, more or less. For a bank, a little bit on the upper range. They back goes high as they range between about 1.5 and 2.2. What you can do with that is then overlay it over time and go get a price to book and get over the last 5, 6, 7 years price to book, and you can see what the range is. For example, Sasfin, and let's quickly go have a look at Sasfin. That stock sometimes gets a price to book as low as 1.1. I mean, Sasfin's price to book is 1.1. The stock is incredibly cheap, and you should frankly be buying it. So here, net asset value on Sasfin is sitting at 51.37. There's the price. So they call it price to NAV here. They're telling me the price to NAV is 95. In other words, it's trading below net asset value price. Now, it's actually peaked up a bit since those June 2017. But if we've got a net asset value of 51.37 and we have a share price of 52, we're pretty much buying Sasfin at its breakup value. Now, it's going to make profits for us. It's got a dividend yield. What's its current dividend yield? Of 3.7. So not only have you got 3.7 in terms of dividend yield, which you're getting paid, so that's about $1.80, $1.90 you're getting paid at the moment to hold Sasfin. You're also buying it more or less at its breakup value. Now, let's take that net asset value in Sasfin and say, okay, let's discount it 10%. Okay, so you're buying this at a price to book of about 1.1. For Sasfin, that's cheap. You buy Sasfin at a price to book of 1.1, you sell it in a price to book of about 1.45. Which in a simple math is telling you a move of around about 30% or so. Now, don't rush off and buy CFDs on Sasfin. Don't know if you can, but this will play out slowly over time. And of course, that net asset value can change down as well as up. Typically, it's going upwards, but it certainly has the risk where that net asset value could drop. So that's what I love about the price to book or price to NAV, whichever you want to call it, and particularly in banks. And Sasfin is just one that I watch. And in fact, I hadn't checked it in a bit. Last time I checked it was at a fair premium to that price to book. I think two things have happened. I think the net asset value price has increased, and I think we've seen some pressure on the share price. Yeah, so Sasfin's been up at 76 Rand back in Feb. They said their book was worth 50. They were at 1.5, and 1.5 is the top end of the range. Sasfin's now come down, and around the 50 level is certainly offering some value. Look, 43 Rand in June was excellent value. Question, aren't they doing some deals that might change that? Absolutely. So Sasfin has, and that's what I'm saying. Don't go rush off and buy anything. Sasfin's doing some deals that's going to have some changes to their net asset value, et cetera, et cetera. You need to go and dig. I don't know where those deals are in terms of, are they done, are they concluded, are they not, but go and do your homework on it. But this is what I like about a ratio. As I said, it raises a flag. Here it's raised a flag for me that says Sasfin is perhaps a great buy. Now, I'm talking here more trading than long-term holding. You might want to hold it long-term. I would put this in my second-tier portfolio, buy and hold for a period of might be years as it realizes, because in 6 months' time, the price might have moved up to the 1.4 book value, but the value of the net asset value might have increased. Thing is, it raises a flag. It says, come look over here. That flag might be a red one that says there's a problem. That flag might be a green one that says there's value to be had here. Quick ratio, another great one I like, particularly when companies have a lot of debt and you're concerned around those debt levels. And this happens from time to time with various different companies. Typically, that's going to result in a rights issue. We saw it with PPC. Was it late last year, early this year? I think it was early this year. Their debt was just overwhelming them, and they had to go and do a rights issue for it. And I saw it coming. I mean, absolutely, I did. A quick ratio is just current assets less inventories divided by current liabilities. Now, I remember we talked about that a little bit here, which is the current ratio. The quick's a little bit better because it's current assets less inventories. And the point being is that inventories are part of your doing business and perhaps not easy to sell. You don't want to have to, if ShopRite had to clear all their shelves to pay off debt, yeah, the debt's gone, but now they've got nothing left to sell. So it's used for companies that are in potential problems with their debt. You quickly go and do a quick ratio and you get a sense of how they're sitting in that regard. And that's what I mean by certain ratios work well in certain points. Not every ratio works at every point in time. So what are you looking for in financial stocks? You look at impairments, which is a percentage of bad debts as total debts. Impairments is a fancy word for just bad debts. Now, the big banks will give you a headline number, an overall number, but then they'll split it down into their different divisions at the same time. And I quite like that. What I also want to do is that, particularly if they're lending fast, and we saw this with Blue Financial Services back in the lead up to the crash of '08, because their book was going so fast, in other words, their total debts was growing so fast, their impairments never looked so bad. Because your impairments are typically on the older debts, and your newer debts have not yet had an opportunity to become impaired. So what you can do is take today's bad debts versus last year's debts and get a more holistic view of what those impairment ratios. And if we'd done it with Blue Financial Services and with African Dawn back in the hype of up to 07, 08, 09, we would have had a lot more red flags being waved at us. Instead of their impairments looked actually quite modest because of that growth in debts. Certainly, I run it on Capitec. You want to keep on seeing what that number is. At this point in time, the banks, all of them, have really put their foot down on lending, which means that even though we have a consumer under pressure, what we're seeing is that bad debts have not blown out. Yeah, bad debts are sitting around 1% for the big banks, higher for Capitec. Of course, they're in a riskier, higher margin space, but they've really been careful with lending. And we can see that evidence by the fact that the bad debts haven't spiked. In 08, 09, the big four banks' bad debts went above 2%. At this point, they're below 1%. And in fact, one of them, I think it may be ABSA, it might not be, don't quote me on that, I think is closer to 0.5% of bad debts. That means they've been lending incredibly carefully. Cost to income, which is my favorite number for banks, partly because Capitec is so great. Percentage of every rand that goes to costs. So if your cost to income is 55%, that means if you make $100, $55 is going to direct costs to make that money. Now, the big banks are all sitting at around 55 to 58. They all say they want to get it lower. I don't think they can. Pre-crisis levels, they were sitting around 51, 52, and they blew out when the crisis happened in 08, 09. And I interviewed Jack and Maria on CNBC in about 09, maybe 2010. And I asked him when we could expect cost to income to get back to the low 50s. And he said to me, probably never. And his reasoning was quite simple. Increased regulation and compliance and FICA and all of that sort of thing has increased the cost of doing banking. Therefore, they're going to struggle to get those cost to income ratios back into the low 50s. The exception is Capitec, whose cost to income sits at around 35%. Now, there's reasons why Capitec is. They're a new bank, so they haven't got legacy systems and the like. They're a much leaner bank. They're also a much simpler bank. You know, they've got a transactional account, they've got a credit card, and the home loans they do via SA Home Loan. So it's much simpler, so there's much less of a cost base around it and the like. Capitec's cost to income in time will probably slide, and I expect it to maybe get into the mid-40s, maybe 45%. But the big banks are sitting at 58, 59, which means for every buck earned, Capitec is making 10 to 13 rand more profit. That's like a third more profit on every rand of revenue. And then embedded value. So when you look at insurance companies, Old Mutual, Sanlam and the like, they are immensely difficult to value. And rather than a net asset value, they use an embedded value, which is bespoke to insurers. And then again, much like a book value, you just look at the share price relative to embedded value. Now, back in the day, in the 90s, you would buy your insurers at discount to embedded value and sell them at premium. These days, they're typically trading at premium to that embedded value. But still, it's relative. Are they trading at a 10% or a 50% premium? 50 is expensive. 10 maybe offering a value. Again, raising a flag. Mining, head grade. In other words, of every ton of rock that you pull out of the ground, how many grams of whatever you're mining are you doing? Now, if you're in iron ore, your head grade is giant. If you're in coal, your head grade is massive. But if you're in gold and platinum and the like, your head grade's often, 3 grams, 5 grams. You've got to pull a ton of rock out of the ground to get 2 or 3, 4, maybe 5 grams of the commodity. So a couple of questions. How much to pull that out? Now, if it's on the surface, let's look at Kumba, they were mining the easy parts. The platinum guys were as well. The gold guys, 100 years ago, you could dig a 10-foot hole and pull out gold. Now you've got to go, 4 kilometers underground. So how much to get that ton of rock out, and the quality of the seam? So when a company says, oh, we're buying a new mining asset, a new resource, the question is, well, is it improving head grade? If they tell you the head grade is going to be expected at 2%, it's like, ouch. If you look at Stillwater, recently bought by Sibanye, they announced that, in fact, their initial testing on head grades is better than expected. Now, they would have done the costing on the purchase of an expected head grade. The fact that they're getting a better level, which means that Stillwater is actually going to potentially perform better and more profitably for Sibanye than Sibanye had actually anticipated. All-in cash costs. So that is, what does it cost the company, the miner, to get an ounce of whatever the commodity is to the ground? Or if it's coal or iron ore, which is done in tons, what does it cost to get a ton of the commodity, up to the ground, onto a train or whatever, to whoever's buying it from you. There are a lot of different numbers around this. Our mining companies all publish them. And again, what you're looking at is the trends. What is that all-in cash cost? There are other costs involved. There's costs of debt. There's all of those other costs within the business. But this is telling me, if you've got a mine shaft and you're doing platinum at $990,000 an ounce, but it's costing you $1,500 an ounce, that is not a profitable mine and is unlikely to ever become a profitable mine. If you're doing platinum and you're mining it at $450 an ounce and platinum's $990, that's a good deal. And then reserves. And I'm not going to detail this. In fact, I think I might do a full webcast on it. We have something called the SAMREC code, South African Mineral Reserve codes. And what they do is that when a mining company says that we have gold under the ground or platinum or whatever, they're going to tell you something about it. They're going to say it's inferred, or those different terms mean different things. It tells you what their level of certainty is. A reserve means that pretty much they know it's there. They've been down, they've had a look, they know the quality. Inferred means, well, we kind of, we did some tests and we kind of dug a few little scope holes and type of thing. And it's important to know. But it's also important to know because sometimes a company comes out. And there was a coal company that did this about 3 or 4 years ago. And they said that they had a whatever type of mineral reserves. And it wasn't an official SAMREC code. And I said up front, if you want to do HEPS, do me HEPS or diluted. Don't come with core, normalized, or other nonsense. Because what does core mean? Now we can go read the small print, but they can, the company can change it. So I want them to use SAMREC codes. And if they don't use SAMREC codes, then it's not a deal. And further from that, you then get bankable feasibility studies and feasibility studies. And again, feasibility study means, a couple of geologists went over, pitched a tent and did some digging, and we think we can do a mine here. A bankable feasibility study means you've done a lot more work, and now you can actually take it to a bank and maybe get money for it. But it's a much more deep and involved process, so I'm going to leave it there. And of course, then the Australians have their own, as opposed to the SAMREC, they use a different version. But we need to understand those if you're looking into mining stocks and understanding what the different miners are doing. Retail, there's a couple that I look at. I look at sales per square meter and sales per staff member. So Pick n Pay has always had very low sales per staff member relative to ShopRite. Now, obviously, they're doing a retrenchment, and that will then help that number. But simply, if ShopRite does 100,000 sales per staff member a month and Pick n Pay does 50,000, you're like, that means they need a lot more staff, a lot more cost, and which is the better business? I also like to see how the per square meter. Now, the per square meter is incredibly hard because where do you get the square meters? Staff you can always get. They're always telling you how many staff they might give it to you the nearest 1,000 or something like that. But the square meter is hard to find. Sometimes they talk about it in their annual report, sometimes in their results, but not very often. You've obviously also got your inventory turnover. I want to see how often inventory is turning. So if your inventory is 100,000 and you do 500,000 sales, it means you turn your inventory 5 times a year. But if you did 1 million sales, then you're turning your inventory 10 times a year. And again, that's a more efficient business. It means they probably have less inventory holdings. It means they probably have very efficient distribution and central warehousing, which we see at ShopRite. So inventory versus sales is one I really enjoy as well, just to give me a sense of efficiencies comparing companies. And that's part of what the business is. Yes, ultimately, we want them to make a profit and pay a dividend. But how do they get to make that profit in order for them to pay a dividend? It is around efficiencies and the like. And part of that is going to be, your turnover inventories, your sales per staff member and the like. And you can play with any of these. I mean, you can go and dream up numbers. Oftentimes the raw data is hard to get, but we can go and play with our numbers and see, well, I'm trying to think, sales per store, average store size, foot traffic, all of those sort of things as well. Basket size. I love average basket size. It's just difficult because they don't tell you how many customers they had through their till point. But, again, what is the basket size? Is it increasing? Is it decreasing? And that it can be quite useful information. Seeing a question come through. So inventory turnover, yeah. I mean that cost of sales. I mean we can start playing, and we can start, and it's not a perfect science. You start playing with some ratios, you make up your own. You think you're going to be the new hipster, and you discover that actually this doesn't really help you with anything. That's going to happen. That's completely fair enough. Margins, operating margins, net margins, gross margins, and the like. We talk about that when we do the income statement, which again you'll find under the special announcements under webinar downloads. But I want to look at those ratios. Pick and Pay results this morning. Operating margin 1.6%. Two things. Firstly, Shoprite's closer to 5.7. Now, Shoprite scores because of their rest of Africa where they get much higher margins. But part of the trick is when Richard Brasher joined, 4 years ago, their operating margin was 1.6. It's still 1.6. Now, he hasn't, he might have increased revenue and all the rest and everything else, but he hasn't increased profitability per tin of baked beans he sells. Now, again, retrenchment processes certainly going to help in that sense. Their loyalty program hurts on that. If they're giving back, and I don't know what it is, but does their smart shopper give back 0.5%? Now, not on everything, but say it's 0.1%. Well, that's on average that's margins they are giving away. Telcos, average revenue per user, which they've moved away from because average revenue per users were falling, so they didn't like that. I still like the average revenue per user. I get that it's falling, but I want to see when it starts to stabilize. So I just take, MTN will tell you we did revenue of X, we got 230 million subscribers. Boom, I get an average revenue. It's dirty because obviously different territories, different spaces, but I like to look at that. And then churn. So churn, they typically quite quiet about. Churn is how many customers are you leaving? Because in the telco space, a customer is going somewhere else. Fundu says sales per square meter is the responsibility of the distribution planning section in the company, which manages the general footprint. Agreed 100%. Yes, no, absolutely. It is around distribution. It's around, store layout. How big are your, and you can't, how wide are your aisles between the shelves? Now, those aisles need to have a certain amount of space. They absolutely do. You've got to be able to have people moving up and down them with trolleys, and you've got to accept that there are going to be perhaps some people packing or stocking shelves. Perhaps a customer stopped and, comparing prices. So, it's not, you can't get it to the tiny, it's not about the tiniest number possible. It's about that efficiency. And as Mfundo says, a distribution planning section, which, all those companies, the Pick and Pays and the ShopRites, the Spars, the Woolies, etc., are all doing. And as much as we like more space when we're shopping, there's a trade-off for it. Square meters cost money. So in closing, it's about knowing your ratios. It's about knowing the key ones. It's about knowing the ones in particular for the different types of industries. And, don't go look for a cost to income in a mining or a retail or telco. Do look for head grade in your mining. So knowing which ones to look for. And I've got those favorites I look for. I also got the ones I know that they don't publish, and therefore I know that I'm going to have to go and create them myself, and crunch those numbers. When you need to, work them out. And don't be scared. There's no ideal ratio. So I say to the point, compare within the industry, compare against peers. You can compare globally within the industry and against peers as well. But if you think to yourself, maybe you've got some retail experience, or maybe you think that banks should be run this way, and you think, what, that ratio could give me some insight into a sector or a company or something like that. Spend the time. It might be an hour or two. Maybe it's an afternoon. Go crunch the numbers and see if it does give you an insight. Investing is about gaining insights. Now, we all get the same raw data in terms of results and all of that sort of thing, but it's how we interpret it. So there is, net asset value, HEPS, return on equity, those sort of things are going to be around, and they are what they are, and they are going to be that. But there's nothing to say that we can't go off and, I know someone who used to do a shopping bag survey. So what he used to do was first Saturday after payday every month. I think it was first Saturday after payday every month. He used to employ a couple of students to go and stand at the entrance at some retail shops, like half a dozen different retail shops around Johannesburg, and simply count how many shopping bags that person saw. And then he tracked it, and you would start getting a trend, and you would start seeing, okay, number of bags is going down, which means this basket size is going down, which means consumer, et cetera, et cetera. Now, he stopped it after about a year because it didn't give him much more valuable insight than he could have got. He could have got that same information from other ways. But what I liked about it was the cleverness of it. There's a thing called the lipstick index. When times are tough, allegedly women buy more lipstick because they can't afford the expensive, funky sort of makeup and stuff. So they go buy lipsticks instead because they're cheaper and simpler. So when lipstick sales start going up ahead of everything else, it's telling you the consumer feels under pressure. Again, there's other ways to tell that, but is that perhaps a better way than we're seeing in others? So play with them, try different ratios, do some Googles for traditional ratios, but also go and Google, crazy financial ratio analysis and see what comes up and see if any are applicable. And if need be, put the effort and the PT in. Ladies and gents, that's me. If there's some questions, certainly happy to take some questions. We're bumped out time at 35 minutes, but I'm at my next gigs on TV. I know someone was asking me about what I was looking at before we started. That there is Viewpoint, very much for traders more than anything else. It's a Standard Bank platform giving me live prices. So I was having a squiz at different live prices. Gives me charts. That's an hourly on the Aussie futures, hourly in the top 40. Gives me different markets. I can pull in ETFs. I've got, this is my sort of home page, I suppose, in a sense, etc. And you find that there. Viewpoint, sign up. I think the first month is going to be free. It is much more a trader tool. What I like about it is it is streaming, so it's sending the prices to me. So if I'm looking at top 40, those are all the shares in the top 40. This is updating in real time as changes are happening at the market. Ladies and gents, not seeing any further questions coming through. We will park it there. I didn't want to go there. I wanted to go there. We'll be back again. So October, so we'll be having November and a December ones. I'm going to spend, I think, a whole session on the Samurai codes because they're so important. And inferred versus this versus that. I think they were spending some time on the Samurai codes. And next month, November, I'll be back for a trading one. So Samurai will be the December one. Ladies and gents, thanks very much for your time today. Cheers all.